The chatter around a deepening economic slowdown has picked up in recent weeks. Some of it is emerging from high-frequency data like PMI, which have shown some incremental weakness. Some of it is stemming from commentary from managements at consumer goods firms. How much of this is noise and how much a real signal is there in all of this chatter? Joining us to help us sift through those aspects is Sajid Chinoy, Chief India Economist at JP Morgan. Sajid, good afternoon. Thanks so much for joining us here on Bloomberg Quint. Until the last time that we spoke to you here on the network, and I think that was a couple of months ago, you were a little bit less sort of worried about the nature or the extent of the slowdown. So let me just first ask you whether your views on economic growth have changed in the last couple of months.
Good afternoon, Ira. Well, it's undoubtedly the case that the recent patch of data has been very soft. You alluded to the PMIs in the last couple of months, softening quite meaningfully. We've seen auto sales have been weak for several months now. IP numbers have been a little bit soft. But I think it's a bit too simplistic to say that India is in the midst of a broad-based slowing, because I would argue a lot of this is on account of both transient and idiosyncratic factors. We know, for example, in the auto market, the emission norms have had some impact. Clearly, the shock from the NBFC sector late last year is feeling its way through the system. It's also the case that global uncertainty keeps rearing its ugly head. And the third risk is, we saw that in the last month's PMI, that as you get close to any election around the world, political uncertainty increases, investment decisions are typically postponed till political uncertainty is resolved. So you're seeing a combination of those factors: the election that's coming up in a couple of months, global uncertainty, reappearing from time to time, the after effects of the NBFC, retrenching, so to speak. And also, let's not forget the fact that we've spoken about this in a different context, that the terms of trade have moved so adversely against agriculture. Food inflation this year will be less than 1%. Last year was less than 1%, and core inflation has been at 5%. That's hurt purchasing power in the rural economy. So undoubtedly, there are some headwinds and drags here. But I would argue that if you take a more forward-looking perspective over the next 3-4 quarters, it's not all gloom and doom. I mean, the election will come and go, and hopefully once that uncertainty is resolved, you will see some pickup in investment, I would argue, in the next 4 to 6 quarters, because two things are happening. One is capacity utilization in India today is the highest in 6 years. And number two, despite the fact that NBFC growth has slowed, you've seen bank credit growth pick up very sharply. It's running at 13% year on year for the last 12 months. And the RBI's MPR report a few weeks ago had said that the total flow of funds in 2018-19, adding up bank lending and NBFC lending, was actually higher than the year before. So I think the fact that the deleveraging process has moved on, we should talk about that separately. I think much more can be done. The fact that utilization rates are picking up, the fact that banks are lending again, does augur well for some investment 4 to 6 quarters down the line. And even globally, I would argue that you've got these event risks around Iran, around today in particular, the US-China trade war. But if you strip that aside, the underlying fundamentals are still very good, especially in the US. The labor market's doing very well, red hot. Financial conditions in the US and the rest of the world have eased. Europe has had some positive data flow in the last few weeks, and the China stimulus is clearly kicking in. So I would argue, to summarize, yes, we're going through a bit of a soft patch currently. I think some of these are idiosyncratic, like the auto market. Some of these may be transient, like politics. If you take a 3 to 4 quarter view out, I think growth is not as weak as is feared. The last thing I'll say, however, is I think the one area that we would need to address more systematically is the NBFC sector. And I think some more structural solutions are required in that area. I would argue an asset quality review, an AQR, is at some point post-elections desperately needed, because otherwise every time there is a large repayment that's due in the next few months, you'll have these uncertainties rise up again.
All right, Sajid, that's a great, fabulous summary, but I do have a couple of specific questions, to ask as well. Let me start with the consumption side. So what is the issue? Is there a demand issue which is purely stemming from, say, the rural economy? My colleague Pallavi Nahata had done her data on rural wage growth. And yes, rural wage growth is very, very soft. We've got data until February, particularly real wage growth. So is that the source of the demand problem? Or is there something happening in the urban economy as well, which is not getting captured right now? Is there softness in income growth, which is then spilling over into weaker demand? Can you address, the demand issues that exist and don't exist?
You bet. So the way I look at consumption is over the last 2-3 years, really it was urban consumption that was driving overall consumption. Apart from the fact that government, we should talk separately about the fact that government consumption growth has also been quite strong in the last 2-3 years and been a tailwind towards growth. But it was largely urban consumption that was driving consumption, and this was manifested in the fact that NBFC growth, whether it's autos, whether it's in the housing market, was growing very rapidly, and even banks were growing, lending quite strongly to personal households. So it was urban consumption that was leading consumption growth. Rural consumption, at least from our vantage point, was quite soft, precisely because of the issues we discussed, that there has been some agrarian distress. The terms of trade had moved against agriculture, rural real wages had softened. Now, all of that said, if you look closely at rural wage data in the last 4-5 months, you look at the month-on-month seasonally adjusted real wages, there's actually some good news. It seems that the deceleration has stopped, and at least things have bottomed out, and there's some modest acceleration in sequential wages. Add to that the fact that post-election it will become almost inevitable for the next government to deliver on some of these promises. We've seen that the current government has promised the cash transfer, PM Kisan, and that will play out in the coming quarters. Opposition parties have promised even more expansive transfers. So I think the political economy of India won't allow for the rural economy to be in distress for another year or two. So our sense is over the next 4 to 6 quarters, there'll be enough support for rural consumption to pick up a little bit sharply. Urban consumption, I think, has slowed, both because of some slowdown in NBFC growth, as well as the idiosyncratic issues related around auto emissions, because there are multiplier effects from that. Don't forget, core inflation has been running at 5.5% for the last 12 months. That's a much bigger fraction of the urban consumption basket than the rural basket, and therefore that hurts purchasing power. So there have been a number of drivers that are causing urban consumption to slow. And it won't be surprising to me, especially if the NBFC resolution takes some time to play out, that a year from now it will be rural that will be supporting consumption more than urban, and these lines would have eventually crossed.